Okay, that's going to be cost savings over a 5-year period of time of is going to be about $400,000 in savings there. So we take that 400,000 and we add it to that 1.8 million, and we're going to see that we're looking at a total tangible benefits of 1.8 plus 0.4 equals $2.2 million over that 5-year period of time. All right, so far so good, and this is all pretty easy. Not going to be a lot of debate over these numbers. Here's the problem. The problem is the intangible benefits. Okay, what are we going to do with the intangible benefits? We've identified what appear to be a couple of good ones here. But the question is how do we put a dollar sign on this? Now, if you'll remember back to our previous lecture when we discussed intangibles, we were talking about the fact that people do this in business all the time. IT is a little late into the game to take this on compared to all of the other divisions in the company. Everybody else is quite comfortable with putting dollar sign estimates. And so we need to figure out how we're going to do that here with these two numbers that are going to result in increased sales. We can't guess wildly. That would be irresponsible. And again, just a little bit of review from last time. If the numbers are too high compared to what the actual turns out to be, then we're risking our credibility. If the numbers are too low compared to what we should reasonably expect, then we may not have numbers large enough to be compelling enough to fund this particular IT project. And if the numbers were higher and the IT project is not funded, that ends up being irresponsible in terms of potential benefit to the company. So it's incumbent upon us to get as close as we can to accurate, believable numbers. So how are we going to go about doing this? As we said in the last lecture, it's important to involve people in the other business units in coming up with the numbers for the intangibles. And ultimately, the CFO will be the deciding factor. It would be a mistake for the CIO or IT in general to put dollar signs against intangibles without those being numbers arrived at by consensus from the key influencers in the rest of the company. That puts the CIO at risk. It basically is a no-win situation. So we're going to have to go to the CMO, probably the COO, eventually the CFO, for their estimates on what dollar signs they might feel comfortable in assigning to the intangibles. But it's important for us to do some homework first. We need to take something to those folks when we ask them for their opinions. We don't just start with a blank slate. So, for instance, and there's a lot of ways we might try and put numbers to intangibles, but we might check with a vendor, the ABC Corp, the folks that are selling us the CSR Easy system, and say, for other companies similar to ours, what sorts of reduction in abandoned call rates are you seeing when they can shrink hold times from near 5 minutes down to nearly nothing? Okay, and so the vendor might tell us that our abandoned call rate should go to less than 3%. Okay, based on other customers in similar situations. Now, we also need to go talk to the customer service folks and find out how many abandoned calls are we seeing. And they're saying, okay, well, we're seeing about 50 abandoned calls per day, which results in approximately 10,000 abandoned calls per year. All right. Then next, we want to get some sort of estimate from what percentage of abandoned calls result in losing the customer. So after some customer surveys or whatever, we might estimate that approximately 25% of all abandoned calls result in loss of customer. All right, well, there's another interesting number. Now we go to folks over in the sales department or whoever's going to be keeping these numbers for the company and say, what does the average customer spend with us in sales per year? Okay, and sales might tell us that the average customer spends, let's just say, $1,000 a year in sales with our company. And then we go ask the CFO what the profit margin is for those sales, and the CFO might tell us that the profit margin is about 20%. And so now we have the information to estimate the actual loss in profit from those abandoned calls, or the inverse, if we keep those abandoned calls from happening, what will that be in terms of increased profit to the company? So just putting these numbers down here, 10,000 abandoned calls per year times 25% of those that result in lost customers times $1,000 in sales per customer times 20% profit margin, so that's 20% of that is profit, times 5 years. Okay, and that works out to be approximately $2.5 million in lost profits, or in recovered profits in our case, just from customer retention. Now, we don't necessarily go with this number. We take this number over to the folks in marketing, and we say to the folks in marketing, here is one way we can do this, and here are our assumptions, and we just lay it all out for them, and we go, and we come up with $2.5 million a year in increase, or $2.5 million over the 5-year period in increased profits because of increased customer retention. So the folks in marketing tell us that they know that for every 30-second increase in hold time, it results in a 1-point loss or decrease in customer satisfaction. And they've also tracked that a 1-point decrease or increase in customer satisfaction results in, well, let's just say that they said $400,000 per year swing in sales. And if we multiply those numbers out, multiply by the 20% profit margin and multiply by 5 years, those numbers that they just gave us, what they're estimating is an increase in profits of close to $4 million a year, just based on reduction in customer retention. And so we'll go back over here and we'll say, okay, those are our numbers. And now we'll go through the